Hi, I'm Sara Gelsheimer and I'm a Senior Wealth Manager at Plancorp. And with tax time quickly approaching, I thought it might be helpful to spend a few minutes talking about some different tax strategies. The first tax strategy I wanted to mention was tax loss harvesting. So what does that mean? It's basically when you have a portfolio allocation that you have in mind. For example, 70% stocks and 30% bonds. If one of those asset classes within that allocation happens to go down in value, you could sell out of that particular fund and buy into a very similar fund so that you remain with your overall intended exposure that you had in mind. However, the benefit of doing that is that you get to capture that loss from the original fund. So last year, during the market downturn, when the pandemic first started, we were doing a ton of tax loss harvesting. Lots of areas in the market had gone down in value, so we were able to sell out of a position for a client, capture that loss, and then immediately buy into another position that was very similar. So again, their overall exposure remained the same, but now they have a nice tax loss that they can use to offset future capital gain. Obviously, we don't wish the market to go down, but if it is going to go down, we might as well take advantage of it. So that's one really great tax strategy that you can employ. The next topic would be Roth conversions. So again, we had a lot of clients, especially last year, taking advantage of the down market and even potentially a lower income year, and decided to do what are called Roth conversions, which is basically taking money out of a traditional IRA and moving it over to a Roth. Now, any of those assets you move from the IRA to the Roth account are fully taxable, which is why it can be really beneficial to do it in a year where your taxes might be lower anyway. It's also beneficial when the market is down because you're able to move those dollars at a lower value, and then in hopes that when the market does come back up, they're inside of the Roth account, which has tax-free growth. The next tax strategy I wanted to discuss was making retirement plan contributions. So obviously there are two different types of retirement plan contributions: traditional IRA, traditional 401k, and Roth IRA and Roth 401k options. So whether or not which of those two are best for you really depends on your individual tax situation, but the ones that actually benefit you from a tax standpoint today would be the traditional IRA and the traditional 401k. Contributions to those accounts actually come off of your income for the year. The next item is to give to charity. Obviously, this is a great way to get a tax benefit. Unfortunately, with the standard deduction becoming so large, very few people are actually itemizing their deduction and therefore giving to charity. Or I should say getting a tax benefit for giving to charity. So we have a lot of clients who give in bulk. So basically they will clump together a few years worth of their charitable contributions into 1 year so that it pushes them above the standard deduction and allows them to take the tax deduction for it. And they put it into what's called a donor advised account, which allows you to get the upfront tax deduction, so putting your 3 years worth of contributions in today, for example, but you get to actually spread the contributions out over many years. So again, it's a great way to get a tax deduction now, when a lot of people, if they were just giving their regular amounts each year, wouldn't be getting any kind of tax incentive. The other option would be a 529 account. So again, these accounts are designated for qualified education. So contributions into the account, you don't get an actual upfront tax deduction from the federal side, but a lot of states actually do give you a tax deduction. And Missouri is one of those states. So you do get to put in the contribution, and the benefit of those is that they grow tax-free if they're used for qualified charitable expenses. So these are just a few different ways to mitigate your tax situation. But certainly if you have any questions about your specific situation, please don't hesitate to reach out. We'd be happy to help.